First of all, John, I think congratulations are in order. I mean, I think when you sort of made this move, everyone knew you were going to attract a lot of money, but not necessarily that much so fast. What are you going to do with it, John?
Oh, well, thanks so much for having me. And we've already been deploying it. I think one of the advantages is the timing of starting in on this investment process with the capital that we've raised. We're near 16 or 17-year highs in the yield of high-yield municipal bonds. So we've been able to assemble it, invest it into essential service type credits that out-yield the competition with no leverage and no defaulted bonds and no low embedded yield bonds. Well, so that's been helpful in terms of timing.
Well, that's what I'm curious about here is the complexion of this, at least based on what you've publicly released as of March 31st. 63% of the bonds in that portfolio right now are unrated and 18% were below investment grade. You know, John, that's a bit of a contrarian call right now.
Sure. Well, really, high-yield municipals, including the non-rated segment, are a subset of the overall municipal market, which is a very high-quality market. So non-rated doesn't mean they're bad bonds. It means that there may be some construction involved, there may be some ramp-up involved. Ultimately, you're going to get to that monopolistic tendency of the essential infrastructure that benefits the community. That's the objective. And this might be a little bit earlier stage, and therefore some of the issuers go without a rating initially, thinking that they will get a rating 2 to 3 to 4 years down the road.
Also, unrated or non-rated means you're doing a lot of the legwork yourself. There's a lot of due diligence on your part. You've been called the king of high-yield muni bonds. What is the ideal size for a fund? Because if it's too big, you move the market, and you have to hunt for lots of different opportunities. Too little, and you miss out on some great opportunities as well. Yeah,
you're exactly right. The largest funds in high yield are in the $17 billion area. The mid-range is 8 to 10 billion. So I think if we're in the mid-range down the road eventually, if we're in that $8 billion area, we'll have enough capital to really structure unique opportunities and situations for investors, but still stay very selective in this niche asset class.
And Romain mentioned that your new high-yield muni bond fund has amassed $1 billion in AUM in less than 5 months. What portion of your buyers are long-term First Eagle clients who are largely new to this particular asset class, high-yield munis, versus just brand new investors overall?
We think that those are the top two categories that you just mentioned, both brand new investors and long-term First Eagle clients. I've spoken to kind of both categories of investors. I don't have the precise breakdown per se, but really this is complementary to what First Eagle already offers in terms of very specific targeted asset classes where they feel that alpha can be derived in an inefficient market, being a little bit different from the index and really delivering that alpha from individual security selection. So that fits the philosophy of First Eagle, so that's why it's a good fit within their overall portfolio and their overall base of clients.
I want to get some thoughts here on a couple of the holdings in the portfolio. Two of the biggest are Brightline, that's the big rail line down there in Florida, and another one was a casino in New York and an Arkansas steel mill.
Sure. Yes. Well, starting with the Brightline, many people are starting to know about the Brightline, but I would say it still needs more and more brand recognition over time, and will get more brand recognition over time. But they've accomplished a lot over the last 8 years. The system is the only high-speed passenger rail to be developed predominantly with private funds in the last 100 years. It goes from Miami to Aventura to Fort Lauderdale, Boca Raton, West Palm Beach, and the Orlando International Airport right now, for a total cost in the ground of approximately $6 billion because of a clever starting point buying Florida East Coast Rail. They actually carried more passengers than the Acela did in the month of March. So that's been a project that has had both some skepticism, but I think increasingly going forward, more and more fans are getting on board, so to speak. No pun intended. Another credit in New York that we've been involved in that you mentioned. Yeah. There are actually two gaming facilities in New York that have been issued this year. One in upstate New York, the Oneida, and another in the middle of Suffolk County, Long Island, the off-track betting.
Yeah.
In both cases, they're enhancing their venues for people who want to, say, gamble locally as opposed to taking the trip out to Las Vegas. And interestingly, in Arkansas, there's a project by U.S. Steel, and also there's a project by the same developers as the Big River project, which is called High Bar, and they're making rebar. So some corporate-oriented public-private partnerships can be issued on a tax-exempt basis when they're doing something environmentally favorable, like pollution control and waste disposal. That's how they issue those municipal bonds.
Got it. John, really appreciate your joining us. John Miller of First Eagle Investment Management.